So it's Sunday, August 9th, 2026. And for 4 straight weeks now, the spot price of uranium just hasn't moved, like not a single cent.
Right. It's just completely flatlined.
Exactly. It is stuck at exactly $86.50 a pound. And, on a chart, that looks perfectly calm. But do not let that price tag fool you, because beneath the surface, we've got a collapsing Middle East ceasefire and a $50 billion U.S. government walled garden that are basically about to violently collide. So, welcome to this deep dive.
Glad to be here for this one.
Our mission today for you listening is to take this massive stack of intelligence reports, geopolitical risk assessments, and this week's earnings previews and answer one core question.
Is this the week the 8650 ceiling finally shatters?
Right. Whether you're an institutional investor, an energy policy wonk, or just someone who is fascinated by how microeconomics and global conflicts intersect, you are going to want to pay really close attention, because this week is a masterclass in how government policy and global anxiety move markets.
Yeah, it really is. I mean, we would classify this as a massive geopolitical overhang week.
Okay, what does that mean exactly?
Well, if you look at the confirmed corporate calendar, it's actually relatively light. I mean, we have a few earnings prints, some construction updates, but the macro risks hovering over those updates are the highest they have been since early June.
Wow.
Yeah, every data point we get this week is going to be filtered through the lens of international conflict. That geopolitical shadow, it just sets the mood for every utility boardroom in the entire world right now.
Okay, so let's unpack this, because, we can't even look at a corporate balance sheet until we talk about the fire burning in the Middle East.
Right.
Our sources are absolutely unequivocal this morning. The US-Iran 14-point ceasefire, the one that was heralded back on June 17th, it is functionally dead.
The breakdown is just total at this point. The United States has officially reimposed its naval blockade. And in response, you've got Iran's foreign minister actively accusing Washington of violating the nuclear clause embedded within that whole MOU.
Which was basically the centerpiece, right?
Exactly. Consequently, the entire nuclear negotiation track, which, as you said, was supposed to be the crown jewel of that ceasefire framework, it's on indefinite hold.
And it goes way beyond diplomatic statements, too. We are seeing CNN reports confirming that Houthi proxy activity has resumed in the region.
Yeah, the physical escalation is real.
There are active claims of an attack on a Saudi oil tanker. Plus, we have statements from former President Trump explicitly stating that the reopening of the Strait of Hormuz is coming, quote, soon.
Right. So the intelligence indicates the blockade scenario is live enough that both sides are, actively managing their public messaging around it.
So for the markets, what's the trigger?
The immediate decision point is whether this escalation remains in this sort of gray zone of proxy skirmishes, or if it crystallizes into a formal Iranian closure of the Strait of Hormuz.
Okay, here is where I need to play devil's advocate for a second.
Go for it.
Because I'm looking at global supply chains, and uranium does not physically transit the Strait of Hormuz.
No, it doesn't.
Right. A blockade there disrupts oil, disrupts liquefied natural gas, but the physical logistics of moving yellowcake uranium from, say, Kazakhstan or Canada are completely unaffected.
That's true.
So why do our intelligence sources estimate that an Iranian blockade of an oil route could trigger a, $5 to $10 per pound spike in uranium spot prices within 48 hours?
Well, what's fascinating here is the whole psychological mechanism of the energy security premium. You were entirely correct about the physical ships. Uranium logistics are largely insulated from the Gulf.
Right.
But commodity markets do not operate in a vacuum. They operate on sentiment and risk models. If the Strait of Hormuz closes, even for just a brief 48-hour window, oil is projected to spike to $120 a barrel, maybe higher.
Oh, wow.
Yeah. And when that happens, energy security suddenly ceases to be a theoretical talking point, right? It becomes the dominant frame for every single commodity on Earth.
So it's essentially a massive fire alarm. The fire might technically be in the oil markets, but the alarm rings loud and clear inside the boardroom of a nuclear utility in Chicago or Paris.
That is exactly the dynamic. Imagine you're a utility executive, right? You've been holding off on signing long-term nuclear fuel contracts, just playing chicken with the market, because you think energy security is just a medium-term concern. You think it'll eventually cool off. A closure of the strait delivers this visceral, real-time demonstration that supply chain fragility is an immediate existential crisis.
It makes it real.
Very real. Suddenly, the unique appeal of uranium, The fact that it's a baseload fuel source immune to Middle Eastern logistics bottlenecks, that becomes aggressively explicit.
It reminds them how fragile their other energy inputs are, so it forces them to just lock in whatever secure baseload they can find.
And they will pay a premium to lock it in. If the escalation continues in the gray zone without a full closure, the models suggest a geopolitical premium of $2 to $4 a pound will sort of bleed into the spot price.
Which would finally break that 4-week 86.50 deadlock.
Exactly. But if the strait actually closes, the sources suggest term contracts could be pulled from negotiation entirely. Producers would instantly recalibrate their risk premiums upwards.
Which, honestly, provides the perfect connective tissue to the next massive theme in our stack of sources.
Right, the domestic side.
Yeah. If the global market is this volatile and the Middle East is proving to be a perpetual powder keg, the immediate reaction from Western governments is to build a fireproof house.
Yes.
We are seeing the United States actively constructing a policy framework to just pull nuclear fuel procurement away from the Wild West of the global commodity market and force it into a highly managed domestic supply chain.
The underlying goal there is a complete structural shift. The U.S. federal government is aggressively trying to insulate its domestic baseload power from international shocks.
I look at it like building a toll road where there used to be a free, open highway.
That's a good analogy.
The government is essentially saying, you can still try to navigate the global market, but we are going to build this secure domestic lane, and we're going to mandate that you use it. And the biggest tool they're using to force traffic onto that toll road is Section 232.
Right, the Section 232 proclamation from January of this year. It laid the legal groundwork for that exact mechanism.
For anyone who doesn't track trade law, what is that?
It's a trade statute that allows the government to adjust imports based on national security threats. Our intelligence flags this August reporting window as the next highly probable time for a Federal Register notice from either the Bureau of Industry and Security or the Department of Energy.
And why is that notice so critical?
Because it will establish the specific domestic content threshold.
Meaning the exact percentage of uranium that U.S. utilities are legally mandated to buy from domestic American sources, regardless of what the spot price is doing globally.
Exactly. And the specific number the market is hunting for is 15%. The analyst notes indicate that if this threshold is set at 15% or higher, it could act as a catalyst for a 10 to 20% single-session re-rating for U.S. domestic producers.
Wait, a 10 to 20% jump in one session?
Yeah, it directly impacts companies that have assets in the ground ready to go. We're talking UEC with their Burkalla projects, Energy Fuels, Encore Energy.
But if they don't publish that rule this week, the utilities don't have to change their behavior yet. They can just keep leaning on their existing workarounds.
Right.
The sources mention utilities drawing down their Russian SWU waivers ahead of a January 2028 deadline. Let's make sure we clarify that for anyone not steeped in nuclear engineering.
Good idea.
SWU stands for Separative Work Unit. It's basically the measurement of the effort required to enrich raw uranium into the highly potent fuel needed for a reactor. The U.S. banned Russian enriched uranium, but they left a loophole, this waiver system, until 2028, right?
Yeah, that waiver system acts as a pressure release valve. Utilities have been using those waivers to slowly, kind of comfortably, transition their enrichment supply chains.
But the clock is ticking.
Right. As that 2028 deadline approaches, the grace period evaporates. That is why Section 232 is so pivotal. If a proposed rule is published this week, it forces the utilities to immediately price in domestic sourcing.
And if it's delayed?
If it's delayed, that policy-driven re-rating is pushed down the road, and utilities will just continue to exploit those Russian SWU waivers for as long as legally permissible.
Okay, so Section 232 is just the regulatory stick. We also really need to talk about the carrot, which comes in the form of a staggering amount of federal money.
Oh, massive amounts.
The Department of Energy has established a $50 billion capital deployment target for what they are calling life cycle innovation campuses.
$50 billion. It represents the most concrete institutional expression of industrial policy in the U.S. nuclear sector we have ever witnessed.
It's historic.
Truly. On July 28th, the DOE selected 5 finalist states to host these campuses: Utah, Tennessee, Oklahoma, Louisiana, and Idaho. However, they have explicitly signaled that only 3 of those states will ultimately sign binding hosting agreements.
Well, Utah wasted absolutely no time. They signed a memorandum of understanding on the exact same day they were selected.
Yeah, they moved fast.
Very fast. So the spotlight this week swings entirely to Tennessee and Oklahoma. We are watching to see if they issue formal site preference letters. And it makes sense why those two are front runners, right? Tennessee has the legacy of Oak Ridge, and Oklahoma has massive established infrastructure from its Kerr-McGee heritage.
Yep, and if we connect this to the bigger picture, an announcement from either Tennessee or Oklahoma this week fundamentally changes the investment landscape.
Because it moves the concept from aspirational policy to operational reality.
Exactly. The moment a binding hosting agreement is signed, the geographic specificity of this domestic infrastructure becomes impossible for institutional capital to ignore. It is no longer a theoretical government white paper. It becomes a tangible, operational investment thesis.
So it de-risks the whole region.
Instantly. If you are looking at uranium enrichment capacity, fuel fabrication facilities, or mine development in those specific states, they instantly gain a massive policy anchor. That physical permanence directly and immediately lowers the project financing risk premiums for any company operating in that zip code.
Okay, so if the government is building this domestic toll road, we need to look at the companies setting up the toll booths. We have two major corporate events on the calendar for Monday, August 10th that give us direct insight into this dynamic.
Right, we got to look at both ends of the spectrum here, the operational reality and the developmental pipeline.
Let's tackle the operational side first. Monday, after the market closes, Ur-Energy releases its Q2 results. Their conference call is Tuesday morning at 11. They operate the Lost Creek facility in Wyoming, and they utilize ISR mining in situ recovery. For those unfamiliar, instead of blasting a massive open pit, ISR works kind of like a French press, right?
Yeah, that's a great way to picture it.
They pump a chemical solution into the ground to dissolve the uranium in the ore, and then pump that pregnant liquid back up to the surface to process it. It's cheaper, leaves a much smaller environmental footprint. So what are the metrics that actually matter in this specific earnings print?
So we are monitoring three specific variables with Ur-Energy. First, the pure production volume at Lost Creek. We need to see if they are scaling toward a quarterly output that actually puts meaningful physical domestic pounds in front of utility buyers.
Right, rather than just running a lifestyle mining operation.
Exactly. They need to show real volume. Second, the realized price per pound.
Because there is a massive gap in the market right now. The spot price is sitting at $86, but the long-term contract indicator, what utilities pay to guarantee supply years out, is hovering around $97.
Which is a huge spread. Finding out where Ur-Energy is selling their pounds reveals whether they have the leverage to capture that $97 term premium or if they're just forced to sell into the spot market at $86.
Got it.
But the third variable, honestly, is arguably the most critical for the macro thesis.
Here's where it gets really interesting. The numbers on the spreadsheet might actually take a back seat to what management actually says on the Tuesday morning call.
Yes, we are listening intently to the management commentary to find out if they are fielding direct commercial inquiries from U.S. utilities that explicitly reference the Section 232 domestic sourcing mandate.
Because Ur-Energy sits at the exact convergence point where this new policy architecture is supposed to channel demand.
Right. If utilities are calling Ur-Energy and asking for pounds specifically because they are American-made, that means the government's policy is officially moving from the Federal Register into actual commercial procurement contracts.
They're the canary in the coal mine.
Exactly. Confirmation of that domestic sourcing language entering utility conversations is an immediate bullish signal for the entire U.S. domestic producer stack.
And if they don't say anything.
Conversely, if Ur-Energy prints a weak quarter and management offers no commentary on Section 232 tailwinds, the market will likely view it as a neutral to negative event for them specifically, even if the broader structural deficit thesis remains completely intact.
Okay, that covers the operational side. Moving to the developmental side, we have NexGen Energy. They are also releasing Q2 financial results and a construction update on Monday and Tuesday.
Right.
NexGen is developing the Rook-I project up in Saskatchewan's Athabasca Basin in Canada. This is widely considered the most significant uranium development stage project in the Western world. They secured their construction license from the CNSC, the Canadian Nuclear Safety Commission, back in March.
And with a company at NexGen's stage, the narrative is entirely about construction execution. The underlying resource thesis is proven. Everyone knows the uranium is there. What drives the stock valuation now is forward guidance. Every time management confirms an on-schedule milestone, it mathematically compresses the risk discount that the market inherently places on development stage mining companies.
But they aren't just building a mine. They are behaving like a fully operational sovereign producer.
Very much so.
The sources highlight a brand new term sheet disclosed this week where NexGen committed 1.3 million pounds of uranium to a U.S. utility at market prices. That brings their total contracted order book to 11.3 million pounds.
Which is wild.
They are locking in massive contracts before they have pulled a single ounce of commercial uranium out of the ground.
Yeah, that level of pre-contracting is a massive show of operational confidence. It demonstrates they are not merely hedging to satisfy debt covenants, They are aggressively pricing their future product at whatever the market dictates it will be worth when Rook-I finally comes online.
So the pace of that contracting is a key metric to watch in the commentary.
Absolutely.
But to actually get that uranium out of the ground, they have to navigate some of the most complex engineering on the planet. What are the hard construction numbers we are looking for in this update?
There are 3 specific operational metrics here, too. First is the shaft freeze timeline. They have previously indicated that ground freezing operations will begin in early 2027, ahead of sinking the main shaft mid-year.
And the reason they have to freeze the ground, and this is crazy, is because the Athabasca Basin is essentially a giant porous sponge holding a massive underground lake.
Right.
If they just started digging a shaft, it would instantly flood. So they literally have to pump super chilled brine into the earth to freeze the water table completely solid, creating an ice wall and then mine through the ice.
It's incredible.
It's incredibly capital intensive.
It is a massive engineering hurdle. And any delay in that freezing schedule cascades through the entire project timeline.
So what's the second metric?
The second metric is logistics. They're scheduled to confirm the extension of their airstrip to 5,840 feet by December of this year.
Which is crucial.
Completely. In a location as remote as northern Saskatchewan, if you cannot land heavy cargo planes, you cannot build the mine.
Logistics dictate everything. And the third metric?
The capital expenditure budget. In August 2024, the construction cost estimate was pegged at 2.2 billion Canadian dollars.
Okay.
Any deviation from that figure, inflationary blowouts or scope changes, is the session's definitive stock-moving event. If they confirm they are on budget and on schedule, it provides this constructive halo effect for the entire Athabasca Basin development pipeline.
But if they miss it?
A cost overrun, however, would represent the first material negative signal since the CNSC license was granted. Their entire multi-billion-dollar valuation is predicated on execution credibility.
Okay, so North America is frantically building out this walled garden. The U.S. is writing policy, and Canadian developers are freezing the earth to feed that demand. But the rest of the global chessboard is not sitting idle.
No, definitely not.
We have to look at how the East and the global South are moving.
The global dynamics are shifting rapidly, beginning with Kazakhstan. Kazatomprom, the world's largest sovereign producer, recently released their H1 data, and the volume metrics are staggering. Group sales volume jumped 19% year-on-year, and attributable production rose 10% to 18.34 million pounds.
Okay, wait, let me push back on that for a second.
Sure.
The entire bull thesis for uranium over the last 3 years has been predicated on a structural supply deficit. If the absolute biggest player in the market just bumped their production by 10% and they have sustained that output for 2 consecutive quarters, doesn't that flood the market and destroy the deficit narrative?
It absolutely places pressure on the market's long-held assumption of Kazatomprom's supply discipline. But what's fascinating here and what protects the deficit narrative is their realized price.
Okay.
Their realized group price for the first half of the year was just $67.88 per pound.
That is 22% below the current spot price of $86.50.
Yep.
Why on earth are they selling their premium asset at such a massive discount?
Because of the inertia of legacy contracts. They're delivering pounds into contracts signed years ago when the price of uranium was significantly lower.
I see.
The critical mechanism to understand here is that as those legacy contracts expire over the next 12 to 24 months, Kazatomprom will replace them with contracts priced at current market rates.
Which are much higher.
Right. So as their realized price naturally rises toward that $86 mark, their financial imperative to aggressively overproduce actually diminishes. They will be able to hit their sovereign revenue targets by selling fewer pounds at a higher price.
So the watch point when their full financial results drop later this quarter is whether that 10% production increase was a temporary phenomenon, perhaps due to a brief easing in their sulfuric acid supply chain, or if it represents a sustained structural shift in their mining strategy.
Exactly. If the 10% increase proves to be permanent, institutional investors will have to shift their focus almost entirely to demand-side drivers, because the supply-side constraint thesis will take a severe reputational hit.
Speaking of demand-side drivers, the West isn't the only group realizing that global supply is vulnerable.
Right.
Sources point out a major move by India. On July 10th, India's NTPC Limited, their massive state-owned power utility, issued a sovereign tender specifically targeting overseas uranium mine acquisitions, and the bidding window closed on July 16th.
The scale of this ambition is critical. They are actively targeting equity positions in operational mines and advanced projects across Canada, Australia, Kazakhstan, and South Africa.
Wow.
Yeah, and a sovereign procurement evaluation of this magnitude typically requires a 4 to 8 week review period. That puts us squarely in the window for a shortlist announcement anytime from this week through early September.
Now, if you are an investor focused solely on Western utility markets, you might think an Indian sovereign tender doesn't affect you.
But it does.
It really does, because it is a pure zero-sum game.
The physics of the market dictate that if a publicly disclosed shortlist names specific advanced projects in Canada or Australia, those assets are instantly vaporized from the pool of commercially available supply for Western utilities.
Right. If the sovereign wealth of India purchases the asset, a U.S. or European utility cannot contract that ore to keep their lights on in 2028.
Exactly. It represents a concrete, structural downward revision for Western supply models.
And while India is shopping for assets in the West, we are also watching new production spin up in Africa to try and fill the void. Lotus Resources officially restarted their Kalakara mine in Malawi earlier this month after finally completing the remediation of their acid plant.
Right, so the narrative surrounding Lotus has officially transitioned from will they restart to how aggressively can they scale.
What are they aiming for?
Their stated target is a steady-state production profile of approximately 2.4 million pounds annually by the fourth quarter of 2026. The data point we are hunting for this week is any official announcement regarding the velocity of that ramp-up. We need to compare their July production figures against the baseline of 155,900 pounds they produced in the June quarter.
If they are hitting their targets, it injects about 600,000 pounds a quarter of Western accessible supply into the market.
Yep.
If they announce a delay, it simply reinforces the frustrating pattern we have seen across the sector for 3 years. New mine supply consistently misses its delivery timelines.
And, you cannot discuss African supply without addressing the severe geopolitical friction in Niger.
Oh, absolutely.
The arbitration between the government of Niger and the French nuclear giant Orano is ongoing at the ICSID, the International Center for Settlement of Investment Disputes. Last September, the ICSID tribunal explicitly ruled that Niger is legally prohibited from selling or transferring SOMAR uranium to any third parties.
And SOMAR represents roughly 5% of total global uranium supply.
It's massive.
But Niger has openly defied that international ruling, and Orano was forced to condemn an unauthorized shipment last year.
Right. So the watch point this week is whether Orano's press desk releases any new allegations of unauthorized shipments. And more importantly, we are watching for any intelligence suggesting that European or U.S. entities have purchased Nigerian uranium in direct defiance of the ICSID injunction.
Oh, because that would be huge.
It would dramatically escalate both the legal liabilities and the geopolitical stakes surrounding that 5% of global supply.
Okay, so what does this all mean? Let's pull the camera back and synthesize this. We are looking at a commodity market that is quite literally holding its breath.
Very much so.
You have a spot price deadlocked at $86.50, waiting to see if military escalation in the Strait of Hormuz will trigger an energy security panic that breaks the ceiling. Simultaneously, you are digesting a massive $50 billion shift in U.S. domestic policy while closely monitoring the earnings of companies like Ur-Energy and NexGen, who are tasked with actually building that localized infrastructure.
It is a phenomenal moment in the history of energy markets.
Yeah.
You are witnessing in real time the exact moment a globally traded commodity is forcefully transformed into a highly guarded strategic national security asset.
It really is incredible to watch, and I want to leave you with a final thought to mull over as you watch the news out of the Middle East this week. We discussed India's NTPC putting out a sovereign tender to buy up Western mines, and the U.S. government utilizing billions of dollars to construct a walled garden domestic supply chain.
Right.
If massive nation-states with effectively unlimited capital are now the primary actors securing this fuel, what happens to the independent utilities and the smaller countries caught in the crossfire? Are we rapidly entering a new era of uranium nationalism where the highest bidder for nuclear fuel isn't a power utility trying to keep the lights on, but a sovereign nation-state treating it as a military-grade strategic asset?
This raises an important question about the fundamental architecture of the market going forward. The era of treating uranium like any other standard fungible commodity, it's decisively over.
It certainly looks that way. Well, thank you for joining us for this deep dive. Keep your eyes on the Strait of Hormuz, watch the numbers coming out of Wyoming and Saskatchewan, and we will see if that 86-50 standoff finally breaks this week.